Saving money for retirement is a crucial component of financial planning, and there are several ways to invest money when it comes to your retirement goals. One option is, of course, to invest in stocks or exchange-traded funds, ETFs. ETFs are one of my favorites because they allow you to invest in a variety of stocks. And if you're busy like me, they can help you diversify with a single click. SCHD is one of the most well-known ETFs, and with good reason. What is SCHD? The Schwab U.S. Dividend Equity ETF, abbreviated SCHD, is an ETF that replicates the performance of the Dow Jones U.S. Dividend 100 Index. As the ETF seeks to expose investors to high-quality U.S. companies with a track record of stable dividend payments and dividend increases, the index consists of 100 high-dividend-paying stocks from U.S. companies. However, how does the SCHD fund operate? Because the SCHD is a passively managed ETF, its portfolio manager does not actively buy or sell securities in an effort to outperform the market. Nonetheless, the holdings of the fund are chosen based on the index it tracks, which is made up of 100 high-dividend-paying U.S. corporations, and the fund downs a representative sample of the equities of these companies. The new holdings will be released by SCHD in a few days, according to what I heard from Schwab. So be prepared for that and stay tuned to my channel as we will be going over these new holdings in detail. The fund's holdings are reviewed and rebalanced quarterly to ensure that the portfolio remains in line with the index. New holdings. The goal of the fund is to expose investors to businesses that pay dividends, which is crucial for people who are saving for retirement. The cool thing about investing in an ETF like SCHD is you don't even need to sell off your shares if you started buying now and waited 20, 30, 40 years. You're probably going to be paid more in dividends by that point than you would be by saving. There are lots of different ways to get to retirement. A lot of people like to save. A lot of people like to invest in roll stocks and then slowly sell off their assets as they get older and older to help cover their bills and maybe travel the world. Companies that pay dividends are frequently more established and financially stable than those that don't, making them sometimes a safer investment option. But more on why SCHD ETF is a great tool to use for retirement and why I personally currently use it. Dividend ETFs also tend to be more popular because they're less volatile in a lot of situations, providing investors with more stable income that you can track and that you can assume is coming in consistently. Dividend income. The dividend income is first. One of the main advantages of investing in SCHD is the dividend income that it provides to its investors. As we previously mentioned, SCHD tracks the index of the 100 high-dividend-paying U.S. companies. The fund aims to expose investors to these companies, which can provide investors with exposure to these businesses and can definitely help and/or cover all of an investor's expenses. The dividend income received by SCHD can be used by investors to supplement their retirement income or keep reinvesting into more SCHD, which will continue to pay more dividends. When an investor owns shares of SCHD, they are entitled to receive a share of the dividend paid out by the company's funds portfolio with SCHD. Dividends are typically paid out quarterly, and the amount paid out per share is determined by the number of shares the investor owns. Diversification. My other favorite aspect of this dividend is the diversification of the SCHD. Investing in a single stock could be risky because if a company experiences financial difficulties and this stock price drops significantly, you will experience significant losses in your overall portfolio. ETF diversification is the practice of spreading out your investments across different asset classes to reduce the risk of loss and also help you sleep better at night. But if you own a lot of SCHD, you won't feel the pain as much unless there is a market-wide downturn like the one we're currently experiencing because the company is made up of 100 high dividend-paying U.S. companies, and even if the portfolio's value decreases, if you're holding on to a lot of SCHD, you will still be receiving those dividends unless, of course, every single company within SCHD cuts its dividend, which is just impossible. The next thing I want to go through is the dividend calculator. Dividend calculator. The initial investment for my dividend calculator is approximately $15,000, reflecting my current holdings in SCHD. As I mentioned earlier, I'm determined to maximize my purchasing capacity and buy a few shares of SCHD every week. And whenever I receive payments or experience liquidity events throughout the year, I intend to invest even more aggressively. With a starting capital of $50,000 and SCHD's trailing 12-month dividend yield at around 3.6%, I expect consistent returns. Additionally, considering their projected annual dividend increase of 13.7%, my investment outlook appears promising. One amazing aspect of SCHD that I absolutely adore is their remarkable track record of consistently increasing their dividends each year. To put it simply, if you own a share of SCHD, you'll receive a yearly payout. However, what's truly impressive is that they have been boosting this payout at an incredibly fast rate over the past 5 years. This means that just by holding on to the share, investors experience substantial and consistent annual raises. It's mind-blowing how the yield on cost keeps rising significantly over time. Let's take a closer look at the numbers to see how remarkable this really is. My drip is on because I am reinvesting all my SCHD dividends back into more shares. I'm currently 30 years old and planning to invest for 35 years, so I'll be 65 when it's all done. The dividend calculator shows that in the first year, my principal is $15,000, and I'm earning $547 in annual dividends. By year 2, the dividends have almost doubled to over $1,000 per year. The yield on cost increases from 3.65% in year 1 to 4.8% by year 5, which is quite impressive. The compounding effect takes a little time, but by year 6, my principal in SCHD will exceed $100,000. And once it starts compounding, it really takes off. After 35 years, my initial $15,000 investment in SCHD will be worth over $16 million with annual dividends of over $600,000. Although waiting for 35 years may be difficult, the magic of compounding starts taking effect much sooner, within just a few years. What's even more exciting is that if you can contribute more each year, whether through a side job or increased earnings, the snowball effect will accelerate. Speaking of SCHD's 13 expected annual dividend increase, even a conservative estimate of around 7 or 8% can lead to impressive compounding gains. That's why, in my view, this ETF stands out as one of the finest options available in the entire stock market. If you liked what you heard, be sure to like the video and subscribe for more. Thank you, and I'll see you in the next one.